Hello, everyone. Welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets. I am going to be doing this webinar alone today. My colleague Victor is on holiday for the next couple of weeks, so you'll have to bear with me. This webinar is obviously live, so thank you so much for those of you who are in this room watching it live. Please don't hesitate to ask me questions. And for those of you who are watching a recording of this on YouTube or elsewhere, please consider joining us live next time so that this webinar can be more interactive and I can talk about the markets you guys are interested in. So anyway, um, before we begin, please have a read through the risk warning and disclaimer on the screen right now. I'm going to help you by reading the first paragraph. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Okay, guys. So obviously, just a quick reminder, this webinar is happening every Tuesday, 11:30 London time. It's mainly a technically focused webinar. So we talk about live charts on major currency pairs, gold indices, and so on, cryptos as well. We do touch on fundamentals as well, and there's a Q&A session at the end. But you can ask me questions anytime as I speak over the markets. So you can write your questions in the questions and answers box or in the chat window. So this week, just a quick reminder then about the upcoming macro events for this week. And as you can see from this economic calendar I produced yesterday, we have got lots of macro events happening this week. Overnight, we had the Reserve Bank of Australia rate decision. They surprised the market a little bit by not changing their policy wording and said that, obviously Australia is in a lockdown, and the RBA said that it might not impact growth too much. And so they're not going to change their policy outlook that much based on the current lockdowns. We have more data coming from that side of the world. New Zealand employment numbers will be released first thing Wednesday, as well Australia retail sales. We then have global services PMIs. Obviously, the US ISM services PMI will be important because it will give us the latest information about the health of the largest and most dominant sector in the world's largest economy. So the ISM also produces the subcomponents with its PMI, and in particular the employment component of the ISM services PMI will be really important, as it will give us an indication about Friday's jobs report, which will be released alongside the Canadian employment report on Friday. Okay, so ahead of the employment reports on Friday, we have the Bank of England policy decision on Thursday. That's going to be very important for the pound. Obviously, the UK economy has relaxed its restrictions, and the economy is growing strongly. Inflation is above the Bank of England's 2% target. Speculation is on the rise that the Bank of England will soon start tapering its bond purchases before raising interest rates. So at this particular meeting, I don't expect any policy changes, but if the Bank of England does sound a little bit more hawkish than expected, then we could see the pound go up sharply. Don't forget also about earnings. We've had BP today, SocGen, Standard Chartered, all beating expectations. We have LNG, General Motors tomorrow, Glencore, Rolls-Royce, Credit Agricole, and a few others tomorrow. sorry, on Thursday, and then ING on Friday. So there's lots happening both from a macro and micro points of view. Let's now transition to the charts and start looking at some key levels on the major currency pairs and indices, as well as precious metals and cryptocurrencies when we get a chance. So I'm going to start off by looking at the weekly chart of the dollar index. Okay, so as you can see, the dollar index fell sharply last week. This was in response to a dovish Fed, which caused bond yields to fall in the US. Actually, yields have been falling across the world. Let me just bring up a chart. This one here. So this is the 10-year US bond yields, the daily chart. As you can see, yields have been falling, which means bond prices have been rising. So when yields fall, it's a reflection of investors expecting monetary policy to remain loose for longer than expected. Yeah, previously yields were rising during the first quarter of this year because people were getting scared of the inflation. You know that the economy was hotting up or heating up, and investors were expecting the Fed to taper its bond purchases in the next few months. But as we found out, the Fed has actually come out and said we're not going to tighten our belts just yet. We're going to let inflation run above target for a while, and you know the employment situation is still not where we want it to be. So what the Fed is now waiting for is employment to improve further before it starts to normalize monetary policy. So the upcoming jobs reports from the US are going to be really important, starting from this Friday, which if I go back to the report that I had produced, okay, I can't do it from this browser. Anyway, let's go to a economic calendar, Forex Factory. Just want to show you what the expectations were for the jobs report. This is the market is, or analysts are expecting employment to have risen by 895,000 in the previous month, compared to 850,000 the month before. So if you look at the history of this, we've seen a couple of disappointing numbers in May and June, but last month it was quite strong. And this month, once again, the economists surveyed by Bloomberg expect to see a strong showing. So if we get a number like that, that's going to, or even higher, that's going to raise bets that the U.S. economy, jobs market is improving in the U.S. economy, and that tapering bond purchases could be announced in the coming policy announcements from in the coming policy meetings from the Federal Reserve. But if you get a really disappointing reading, then that's going to push yields further lower and cause the dollar to weaken, potentially against the likes of the pound, where the Bank of England is turning hawkish, as well as the some of the other major central banks, like the Reserve Bank of New Zealand. Now, looking back at the Forex charts and the weekly chart of the dollar index, it continues to print lower highs on the weekly time frame. Yeah, so even though we've had a decent recovery of the lows in May for several weeks, we didn't quite take out the high that was hit in April. Sorry, this is incorrect. This should say March high. Let me just confirm. Yeah. Okay. So we didn't really take out the high that was hit in March. or indeed the high that was hit in September. Therefore, as things stand, the longer term trend for the dollar remains bearish. Yeah, it's not as strong as it was previously during 2020, because we've been going sideways. But nevertheless, the lower highs continue to suggest that the dollar remains under pressure, despite the US economy doing considerably better than all other major economies in the first half of this year, and a bit before that. More recently, concerns about rising Delta variant of COVID in the US has caused concerns that there may be another lockdown in the US, even though something like 70% of the US adults have now been vaccinated against the virus. So the rising cases in the US is unnerving some investors, and they're moving out of the dollar and into more racier currencies. Still, it's not a big sell-off. So it's very typical of summer trading, where prices tend to go up and down inside narrowing ranges. Soon it will break in one or the other direction, but for the time being, the technical bias remains overall tilted to the downside because of these lower highs on the weekly time frame. Taking a closer look at the daily chart, the trend line break didn't hold, as the index found resistance from this breakdown area, as we had kind of expected in our previous webinars. Couple of levels to watch going forward on the dollar index, include this area here. As you can see, it was previously support. We broke below it, and we are holding below now. Let's call that area 92.20 to 92.15, I would say. Okay, so somewhere, call it 92.10. So this area between 92.10 to 92.20 is our key short-term resistance zone for the dollar index. For as long as we hold below, the short-term path of least resistance remains to the downside. So from here, if there's acceptance below this shaded region, then the logical levels to for the bears to target would include the area of liquidity below this low, 91.51, which was the most recent low. So there's going to be a bunch of stops resting below that level. That's where I think the dollar index may be heading down to in the coming days, possibly as early as today. But there's potential for it to go even lower, with the next key support coming in around 96, call it 96.65. This area was the point of origin of the previous breakout. So if the dollar index does come to this area, expect to see some sort of a bounce, yeah, depending on how it approaches this level. What I mean by that, obviously, if it starts to come down crashing into this level, then that will increase the likelihood for a bounce. But if it instead comes down and hovers above this level for a while and then tries to break through, then in that case, I wouldn't necessarily expect a bounce there. I would expect a breakdown, because the prior hesitation above the level would indicate that the selling pressure is increasing. Anyway, we'll cross that bridge if and when we get there. For now, these are your key levels to watch. So this shaded region is our resistance, and the dollar index is holding below today. The target in the short term is liquidity below this low at 91.50. If the dollar index were to turn around and climb above the shaded region, then in that case, it would open the door for a potential retest of the bearish trend line around 92.50, possibly ahead of further gains towards 93, and then the most recent high. What happened there? Okay, so that's the dollar index. I can't see any questions. If you have any questions on the dollar index, please ask me now. Now we talked about the Bank of England policy decision, yeah, and so it's only logical we look at the pound against the dollar. Um, I'll have a look at the pound euro as well in a minute or so. Now the cable has been trading inside a wide range for the best part of this year. Yeah, so this was the high made last year in end of last year. Since then, it has been going up and down inside a range. Yeah, so it's been a sideways market because the pound has been strong, and so too has the dollar. But overall, the pound has edged it, and recently, when it broke below this area of support at around 138, as you may remember from my previous webinars, I said I'm looking for a quick drop to around the 200-day moving average and then a quick recovery from there. And as it's turned out, that's exactly what's happened. So looking at the price action in closer detail, um, you can see that we have now broken above the most recent high at around 139. Yeah, so this level was previously resistance. It's offering some support on the retest. Yes, we've gone slightly below it in the last couple of days, but as you can see from today's price action, we are back above this 139 level, which was, as I mentioned previously, resistance. Um, so that level is going to be important insofar as the short term is concerned. For as long as we hold above the 139 level, the path of least resistance is going to remain to the upside. Where do we go from here? Well, the most logical level for me, from a bullish point of view, would be the psychologically important 140 handle. Uh, that level was also previously support and resistance, as you can see from past price action. Um, I'm going to draw the Febs from the most recent high to the most recent low. You can see that we have the 61.8 Fibonacci confluence there as well. The 61.8 comes in at 139.92, so very close to the 140 handle. That area is going to be our short-term resistance. And whether or not it will climb above that area, I think it may depend on the outcome of the Bank of England's policy decision. So what I would look for in the aftermath of the Bank of England's policy decision on Thursday is, um, you know, do we hold above? Is there acceptance above this level? If so, then any rounded retest of this level is going to provide a tradable bounce towards 141 initially, possibly ahead of the previous highs at 142, 43-ish. In contrast, if we see the pound break through this 139 level to the downside and hold there, then any rounded retest from underneath is going to provide some selling pressure back down to the 200-day moving average around here. So that would be my bearish scenario after the Bank of England's policy decision. In the meantime, I am expecting, as I said, the pound to continue climbing higher towards 140. So if you're day trading the pound, it may make sense to look at your shorter term charts and trade on the back of short-term price action. So just to draw a couple of levels for you, the hammerhead here on the hourly time frame comes in at 139.17. That level could be the next support if pound comes back down. There's a similar level around here, but I wouldn't be so sure if this level would hold because of the structure that's been created just above it. you see here. If that candle touched 139, that would have been really ideal because that was the breakout point, but it never came down to retest that level on the hourly time frame. Anyway, so 139 is our key short-term support to keep an eye on today. In terms of resistance, you can see this level right here was offering support previously. Support, we broke below it. Actually, this level has already been tested, and we've got a nice rejection from it. So price is currently retesting that level of resistance at 139.33, and let's see if it breaks above. If it breaks above and holds above, then you could either trade the rounded retest of 139.17 or wait for a clean break above this level, then possibly look for a potential long opportunity on the retest of 139.33 to take you above these double top highs. So that's one way I would trade this in the short term. Remember, above double tops and double bottoms, there'll be lots of stops resting here, right? So people who are short, they will have lots of stops resting above these highs. And usually, the market moves from moves to areas where stop loss orders are resting. So if you get a break above 139.33, that could be the next logical target for the bulls to aim for. The market is a function of liquidity. In other words, price moves from one area of liquidity to the next area of liquidity. Okay, so that's the pound. I talked about the euro pound, didn't I? Let's have a look at that. Yeah, this is the weekly chart of the euro pound, and it's looking bearish, albeit it's not moving sharply. But the breakout attempt above the bearish trend line on the weekly time frame a couple of weeks ago failed, and that created a doji-like candle. That failure suggests to me that price wants to head further lower. And from here, the most logical area for the bears to target would be the low from this candle, when price had staged a sharp rally from. Yeah, so when the pound rallied sharply here in April, what we should have seen was continuation to the upside after a period of consolidation. But instead, that period of consolidation turned into selling pressure. That momentum was lost, in other words. So people who are long this, I think they are the trap traders. And so for that reason, I think their stops are going to get taken out. So some of the stops would be resting below this low, and then larger stops would be resting below these double bottom lows. So I think the euro pound is going to crash below this level, maybe come back for a retest, and then head lower over time to take out these lows. Obviously, a lot will depend on the Bank of England's policy decision this Thursday. So that's the caveat. But from a purely technical point of view, it looks like price wants to head lower. My invalidation level would be a closing break above the bearish trend line on the weekly time frame. So somewhere around here, if we get a close above, let's call it 85.80. There you go. So my invalidation level would be a closing break on the weekly time frame above this bearish trend line. So long as we don't see that, the path of least resistance would remain to the downside, in my view. Right, let's move on to some other markets and talk about indices. And I will start off by looking at the S&P 500, if I can find it. Oh, there you go. So The S&P continues to print all-time highs, and until and unless that trend breaks and we get lower lows and lower highs, the path of least resistance would remain to the upside. So currently the trend is really strong, and I would concentrate on picking up the dips until and unless the chart tells us otherwise. Support at 4,380 held. Sorry, 85. You can see that on the daily time frame, this level was key resistance here before we broke above it, and then it retested it from the upside so many times, and so far it has held. So this level is important because if we now close below it on a obviously daily basis, then that could lead potentially pave the way for a move down to the rising trend line. Now my invalidation level is 4,288. Why that particular level? Well, if you notice here, it was previously a low, and then when the S&P broke below it and closed below it on a daily time frame, what should have happened is the rounded retest of that level should have led to a continuation lower, but it didn't. The trend still remained positive, and the index ripped to a new high. So this level has already been tested. Therefore, there's no reason for it to come back all the way down to this level again if the trend is still bullish. So if it comes around to test this level and breaks below it on a daily time frame, I think that would be really bearish. And as a minimum, I would then expect the S&P to drop below this level, this low here, because that's where people who are long may have placed their stops below. And if that level breaks, then we could see a nice meltdown, potentially a sharp sell-off towards much lower levels. But what we need for that to happen is some bearish fundamental catalyst, and at the moment there are not many catalysts to drive the markets lower, with all the major central banks continuing their dovish rhetoric, including the Federal Reserve. Rising variant cases of COVID is meant to be bearish for the economy, but that only means that central banks will continue their current policy stances and keep their QE purchases intact for longer. So that's not necessarily a bearish factor for the markets, especially for technology stocks and those similar growth stocks. But anyway, it's always best to be prepared because you never know what could happen. And here we have prepared you tactically in case the market does break down. And that would be, in my view, the invalidation level to look out for. So if you go below that, it would also take us below the rising trend line that has been in place for several months. Yeah. But as I keep mentioning, right now the trend is positive. We are still holding support. So if you are a short-term trader, then buying the dips makes more sense right now than even at these elevated levels than looking for selling opportunities. But if and when the trend breaks, the market structure shifts to lower lows and lower highs from higher highs and higher lows, then at that point looking for sell trades would make more sense. You just got to ride the waves and go with the flow of the current. In Europe, similar story, really. If you look at the German DAX, the bullish trend that's been in place since March of last year was retested recently, and that held, leading to a bounce. We haven't quite got to the previous all-time highs, but the consolidation just beneath it strongly suggests to me that we may take out the previous all-time high in the coming days. Now, yesterday, the DAX created a inverted hammer candle on the daily time frame. This is meant to be bearish, but if it was truly bearish, we should have seen some downside follow through immediately at the open this morning. We didn't. So I think that this may be a trap for the bears. So what I would look for on the intraday charts would be a continuation higher to take out liquidity that would be resting above this inverted hammer candle from what I think is the trapped group of traders, the sellers. So if that level gets taken, then the next logical target would be the all-time high for the German DAX index. So the level I mentioned from yesterday's high is at 15,706. On the other hand, if we do get a break below yesterday's low, then at the very least expect the German DAX to retest the bullish trend line and support around 15,355. Yeah. But the trend is clearly bullish for European stocks. This is the Euro Stocks 600 index. As you can see, it's trading at a new high. I think this is a new all-time high. Yeah. Look at the monthly chart. So it's clear blue skies. You don't want to be fighting the trend in this market environment. So sentiment in Europe is quite positive, as is the case in the US. But in the US, the markets have been going up for several months, and hitting repeated all-time highs. So I think the US markets are a little bit overvalued compared to the European markets, which means that Europe has more catching up to do with the US. This is the FTSE 100 daily chart. Price action on the FTSE has been very similar to the pound, the cable. It's been stuck inside a range. But the underlying trend is bullish. And today we've broken out above this short-term bearish trend line, suggesting that we may get a new high for the year in due course. Possibly on Thursday when the Bank of England's policy decision is due. So 72.16 was the previous high for the year. That could be the next upside target for the bulls if we get a daily close above this trend line today. Let's have a look at some commodities now, and starting with gold. Gold's been really frustrating to trade for both the bulls and the bears alike. More so for the bulls, I would say, because on the one hand, you got yields that have been falling across the globe. This is the US 10-year, but if you look at German 10-year, yields in Germany have been falling. Similarly in the UK. And yeah, you get the picture. Yields are falling. In China, this morning they touched a 12-month low. In Japan, yields have been declining again towards the Bank of Japan's 0% target. Despite all of that, so when yields fall, gold tends to rise because gold, falling yields reduce the opportunity cost of holding gold. Yeah. because gold doesn't pay any interest or dividend like stock markets do. So when interest rates or interest rate expectations are on the rise, and bond yields are on the rise, people tend to sell gold and park their money in uh, in fixed income to earn a higher rate of interest. But because yields have been declining in recent times, this should have offered strong support for gold. It hasn't. So that's why I say it's really frustrating. Nevertheless, the trend for gold is positive, I reckon. So if you look at the daily chart here, we have a possible reverse head and shoulders pattern in the making. This is the left shoulder, the head here, and the right shoulder is in the process of being formed. So if you look at, if you concentrate in the right shoulder area, gold had previously found resistance here. We broke above it. Price came back down to retest this area, held, and we moved higher again. We moved above 1810, which is a key level of support and resistance. On a daily closing basis, we are still holding above 1810, which is positive, but struggling to hold it. Yeah. So what I'm looking for is for this 1810 to continue to hold as support, and for price of gold to push higher. The next logical level would be resistance above 1830, where it has struggled in the last several occasions to get past. Above 1830, you have this shaded gray area around 1850, where we have the 61.8 converging with previous support. So that would be the next logical area of potential resistance and a bullish target to look for some reaction. Silver is looking quite well, I was going to say quite strong. It's not really looking quite strong. It's trying to break out above the resistance trend of this falling wedge pattern. Yeah, this is a falling wedge pattern. It's trying to break above this, but it's facing lots of resistance from this green shaded area where previously it had found support. And now this area is offering resistance. So what I am looking for is a clean break above this. Also notice that the price is now forming a small bull flag here. Yeah, this being that pole of the flag. A few days ago, it broke the previous low, and it didn't hold there. Instead, it rallied, took out the high before consolidating. So now it's kind of forming a small flag pattern here, which is a bullish continuation formation. And so if it breaks through this resistance area now, that would be really ideal from a bullish point of view. So a clean break above this area would set the stage for a tradable opportunity to go long on the rounded retest of this zone. And that could then take you to towards the next area of resistance around 2650, possibly 27, and ahead of more gains potentially in the future. But obviously, the immediate target would be these highs here around 2650 to 2700. Notice that there was a similar pattern previously where silver broke out from. It broke above, then came back down to retest the breakout area before taking off. So we could see a similar pattern unfold this time. But as I said, it needs to break first. So rather than preempting the breakout, I think it's best to wait for that breakout to happen first and then look to get on board, because Price is below the 200-day average, below the 21-day exponential, and it's making lower lows and lower highs. So, you don't want to get caught in a trade that could go against you. Obviously, any trade can go against you, but what I'm saying is that waiting for confirmation in this case makes more sense than trying to preempt this breakout or potential breakout, I should say. Crude oil is looking weak once again. Yesterday it fell sharply. Today it's holding firm, but don't be surprised that to see more losses for oil as more supplies come into the market from the OPEC plus group. Now, this red level here, trend line is visible on the monthly time frame, connecting the previous highs hit in 2008, 2012, 2014, and and as you can see here, well, I've just removed it. We hit that trend line last month before oil prices eased down a little bit. So yeah, right there. Price of oil formed a bearish engulfing candle. This is the Brent oil, by the way, not WTI. It formed a large bearish engulfing candle, suggesting that we may have formed a top here. Price then went on to break the most recent low, and then it went on to crash towards 68, 67, and then before staging a recovery. Now it's returned to the point of origin of the breakdown around here, around 75 area, between 75 to 76, and it's reacted from this area again by going down. So what I would be looking for is for fresh selling pressure to come in around 74.50 to 75 area, where it has previously broken down from. However, if it reclaims yesterday's large bearish looking candle and goes above the high of the candle at 75.35, then that would be a bullish sign, because it would point to the weakness from the sellers, and so as a minimum we may get a continuation all the way to the previous high. So that would be the invalidation level here at yesterday's high. Guys, have you got any questions? I can't see any questions in the chat window. Bitcoin here, daily chart. We have broken above the recent range high, and that momentarily looked like a bullish development, because we closed above on this candle, but in the more recent days Bitcoin has gone back below because of lack of demand from the buyers above these levels. So this means that we are once again in a range-bound market, and for that reason there's no clear bias on Bitcoin at this moment in time. So Bitcoin has taken out the low from this thrust candle that was created a few days ago, end of July, which is not necessarily a positive development, to be honest, which means that the path of least resistance in the short term is now back to the downside once again. But overall, price of Bitcoin is contained inside a large consolidation range, which means that it's possible we could drift lower towards the middle of the range before bouncing back. What I would look for now from a bullish point of view is I was going to say a close above 40,000, but I don't know if that will cut it. Maybe if we get a higher high above this high that was created a few days ago, then that would confirm the breakout. But then if you're trading Bitcoin, you will have missed all the move towards that level. So it's really difficult to trade Bitcoin at these levels right now. I guess it's a wait. It's a case of wait and see if you're a Bitcoin trader, unless you excel in trading the ranges. Right, I'm gonna end the webinar here, guys. We have run out of time. I can't see any questions, so thank you so much for joining me. For those of you who were watching this on YouTube, I was gonna say you can join us live for the next session, and you can do that by going to our website, thinkmarkets.com. Go to market analysis, live webinars. Here you can see a list of upcoming webinars. So that reminds me actually that we have a non-farm payrolls webinar this week on Friday. So make sure you register for that. But our regular live market analysis webinars will return same time next Tuesday, 11:30 London time. Okay. So join me for those webinars, and I look forward to seeing you there. Take care. Bye-bye now.